In this presentation, we're going to enter the beginning balance for our checking account so we can complete our bank reconciliation. In other words, we've entered the data into our accounting system with the use of bank feeds. However, we had a beginning balance on place before we entered the bank feeds, and now we need to enter that information in. We can prove that everything looks okay, looks correct by completing the bank reconciliation. Here we go with Xero. Here we are in our Triple G company dashboard. We're going to be starting off by opening up our reports. Let's go to the accounting dropdown. We're going to go on down to the balance sheet, opening up our favorite report, that being the balance sheet report. Once that opens up, we're going to go to the tab up top. We're going to be right-clicking on that tab and then duplicating it. Then we're going to go back to the tab to the left. We shouldn't need the income statement this time, so let's go to our bank reconciliation report. We're going to go to the accounting dropdown. We're going to go to the reports to do so. Then we're going to scroll on down to the accounting section where we have the bank reconciliation summary. Bank reconciliation summary, that's the one that we want. I'm going to right click on that and duplicate the tab on the top. So now we've got our balance sheet, our bank reconciliation. Let's change the dates. Balance sheet, let's bring the date on up to March. That's where we are working. I'm going to bring it on up to March. Bring it on up to March. And there we go. And then we're going to go to the bank reconciliation second tab. We're going to be working, of course, with our checking account, and this is going to be for the date of March too. We'll bring that one on up as well to the date of March. So now, next thing we need to consider is we have our bank reconciliation here. We entered our bank feeds. We've got our bank reconciliation. However, the book balance is, of course, right. The 84,917 matches what's on the balance sheet. The 84,917. That's always the case because that's where it's pulling that number from. However, the bank balance is wrong because if I tie that into the bank statement, it doesn't tie in. It should be this, the ending balance should be that 90,728. What's the difference between the two? Let's bring up the old trusty calculator and do some calculation with it. That's what it's for. That's what a calculator does, is calculate. So I'm going to say this minus the 84,917. That's going to be the 505,811. The 505,811, which of course is the beginning balance. We're off by the beginning balance. Why? Because we entered all the bank feeds as of this month, back a month in time. However, when we started, we already had some money in the account. A pretty good amount of money in this case. But in any case, normally that would be the case. If you're starting an accounting system which you had in another system and then transferred it into this system, then typically you're going to do the bank feeds to have a cutoff date, and then you're going to have to bring in the balances from the prior time period. Or even if you're starting a new company from scratch, often people will actually create the bank account before they put this information into the system, and therefore again you'll have this beginning balance. So that's a common kind of thing. So how are we gonna get this beginning balance in place? We got to get this into the system. All right, let's do that. So let's go back on over to our Xero, and let's go to the balance sheet. And what we need to do is then increase this checking account. This checking account needs to go up. And then the other side is going to be going to the equity side of things. Now, normally when you set up the beginning balances, I would suggest trying to switch your accounting software basically at the beginning of the year, and then enter all your beginning balances in the prior year, just to make sure that you don't double input anything into the income statement. In other words, if you enter all your beginning balances as of, in this case, December of 2019, then you'll have less likelihood of entering anything that's going to be affecting the temporary accounts on the income statement. Everything will wash out, in other words, to the balance sheet, because all the temporary accounts will close out to the equity section. So that's the best practice I would typically, recommend doing. Now here we're out in March. We could enter the beginning balance as of the end of last year, but we don't really need to in this case, because what we're going to do is we're going to increase the checking account, and the other side we'll just put to the equity account. It's going to be someplace in the equity account down here, possibly into just retained earnings, because we're assuming this is earnings from the past, the point in time before we had this accounting system in place. If it was you putting the money in as the owner into the checking account and you want to recognize that, then you could put it into this account here, the capital owner investment. Or if it's from prior period accounting system that's rolling forward, you could put it into retained earnings. The point being, it's got to be somewhere down here in the equity type of accounts. So let's do that first. I'm going to make this account correct. So we're going to go to the first tab, and we're going to say this is going to be money coming in. So I'm going to say the little plus button, and I'm going to say this is receive money. Now, we're not getting the money right now. We got it at some time in the past before we started entering this information into the system. But we're going to use the receive money form so that we can increase the checking account. The other side not going again to the income statement, but to a equity type of account. So we're going to say, who did it come from? We could say owner, like if it was the owner, but we may not know who it's from because it might be from various sources prior to when we enter the data into this accounting system. It's before the cutoff date. So to show that here, I'm going to say this is going to be I'm going to put this in place as of the end of February, because we're starting kind of in March. Now, look, I would usually start the beginning balances hopefully at the beginning of the year, and then enter all my prior data in the prior time period, in the prior year, like in December, when we're starting in November of 2000, or in January of 2020. However, I'll put it in February for this case, and again, it shouldn't matter because we're going to go directly to the equity section, so it would just be kind of like a double check if you were to do so. Okay, so we're going to say the check-in, we're going to say this is going to be the description, beginning balance, I'll say, and we're going to say that the amount is going to be for the amount here. I'm pulling this from our bank statement, 105,811.54. So this is 105,811.54. Is that right? 105,811.54. Yes, that is correct. The other side is going to go to an equity type of account. So I'm going to scroll down here. I'm looking for equity. So here's equity. Now, if it's you that put the money in, like if you're starting a new business and you put the money into the checking account from, like your personal savings account or your personal account, then you might just call it owner's investment. Or if it's rolling over from a prior accounting system, it's probably going to go into the account that everything rolls over into, which would be retained earnings. I'll put it into the investment account just so we can see how it would break out here. So I'm going to put it into the investment equity type of account. So there it is. What's it's going to do when we input it? It's receiving money. Therefore, it's going to be increasing the checking account because we put it into the checking account. The other side is going to be increasing the equity section. No effect on the income statement. All right, here we go. Let's say save that and just check that out. See if I get any kind of error messages when I save it. No, I think it saved it okay. Everything's green, so we're good to go in Xero. So let's go on back to the balance sheet and let's update the balance sheet. See what happens here. See if our cash account lines up. Now we're at the 190,728.54. And so that's the 190,728.54. That matches what's on our bank statement. So that looks good. If I go into that account and see what happened from that last transaction that we did, we're going to have a received payment type of transaction. So if I scroll on down, or actually it should be at the top. Here it is, the 105,811 and receive money. Going back to the balance sheet, going to go down to the equity section now. And within the equity section, we see that we have the capital investment now increased by that 178.11. Now just realize that this current year earnings, that's from the income statement. That's going to roll into retained earnings. So just so you can kind of see what happens with retained earnings, let's pull this up to like 2021. And you'll see what happens with that retained earnings. So I'm going to pull this up to the next year. January, we'll just say January 1st. And what's going to happen when I hit enter or update, this current year earnings is going to roll into retained earnings. So I'm going to say update. And if I scroll back down, now we're in the next year, it turned into retained earnings. So just realize that it's still an equity account, but this is the account that the income statement rolls over into. And this account will just be a permanent account that represents the owner's investment. They never roll it out. Like Xero doesn't take it and clear that out to retained earnings or some other equity account. It's just always going to be there for the life of the business unless you were to clean it out of the investment account. So this is kind of like the investments that you put into the company over the life of the company. So if the beginning balance was from something that you put in, then from your personal account, you might want to put it here and you can kind of break it out. Or if it was from a prior work that rolled over to retained earnings from prior business years, then it might be more appropriate to put it into retained earnings. So now I'm going to bring this back. I'll bring this back to the March 2020 and update that. And next thing we want to take a look is the reconciliation report. Notice now on the reconciliation, if I update this, I've got 84,917. What happens if I update this? What happens to the reconciliation report? Scrolling back down, now it's going to match this at the 197.28.54, right? And that's what ties out here, the 197.28.54. And then it added this reconciling item of the 105.811. Because that's on our books now, but it's not on the bank statement. It didn't come in through the bank feeds. So what's that going to do to our bank feed type of information or our reconciliation reports? Let's go back on over to the first tab, and let's go to the accounting dropdown, go back into our bank accounts, and see if we can complete this reconciliation process. So then I'm going to go on down and take a look at our transactions. Note we don't have any more down here that are showing that are unreconciled from the bank feeds. So I'm going to go back up top. I'm going to go to the manage. And what I want to do is go to the account transactions, manage, and then account transactions. That'll take us basically into that same screen. So instead of us going into the reconcile screen like it normally would when we were going into the reconciliation information, it just simply took us to the account transactions screen. So here's our account transaction screens. You'll note down here that we have this item that is not reconciled. So it's unreconciled. If I go back up top and I go to the bank statement, I don't see that item, right? That item isn't here. So that's going to be the problem. We have it on our books, but it's not on the bank statement. Now, normally when that happens, it might be like an outstanding item, and that's what it's showing as over here, meaning normally, if something's on our books and it's not on the bank statement, it's because we entered it in there and it hasn't yet cleared the bank. In this case, because it's the beginning balance, it's a bit different. It's the fact that we haven't entered all the transactions prior to the cutoff date when we started entering the data. So we need to basically manually reconcile this first amount. This is the only one we should, really need to manually reconcile. Once we've done that for the first bank reconciliation, we should be all good to go going forward. So the way you manually reconcile, we want to be on this account transactions over here. We got to go to the little plus button up top. And then there's an item down here that says enable mark as reconciled. So we have to enable that ability to do so. Once we do that, we'll see a new tab that pops up down here. So I'm going to enable this section. And then we see this item down here that says more. And that's going to give us our mark as reconcile or unmark as reconcile. And that's what we need to get this last piece in there for the first bank reconciliation. We won't need this for the next one. So I'm going to go ahead and check this off. I'm going to say that one is reconciled. I found that on the bank statement where, well, it's not in the data of the bank statement. It's in the beginning balance, which isn't yet in our system. All right. So I'm going to have to check that one off. And I'm going to say check that off. And then this drop down, we're going to say mark as reconciled. So we'll mark that one as reconciled. It is recommended that you only mark as reconciled in cases where the original bank transaction data cannot be imported from the bank. So that's the general recommendation. Again, because it's our first bank reconciliation, this is kind of an exception. So we're going to say mark as reconciled, please. And that should do it. So we're going to say, we'll go down there. Now it is reconciled. So now if I go back to the bank reconciliation, once I update this, you would think that this amount should disappear. So I'm going to go back up top and reconcile, and then scroll back down. Now we're in balance. So this is the bank reconciliation. This amount matches our books as we saw, and also matches now the 90,728.54 on the bank statement. So just note that this is the report that you really want. Like if you were talking to an accountant or an auditor, they would want this report. And you might think, well, why would I even need it? It's so basic. It's just got two numbers that are the same. But remember, if you did like the full service accounting system and you entered data into the books and we weren't entering the data directly from the bank, there would be outstanding items. There would be checks that we wrote that hadn't cleared, possibly deposits that are out that hadn't cleared. And we would have those outstanding items. That would be a difference between the bank balance and the book balance. However, if you're in a system where you're just completely reliant on the bank statement and you're using the bank statement to create your books, which is fine, just recognize you still want to kind of reconcile this report, but it will be a very simplified report. And the thing that we're doing is just trying to tie out between, did we enter everything into the bank, and did we not like duplicate or double enter something into the bank? So you still want to check out this report. And just realize it'll be more simplified than if you were doing, the full service bookkeeping, but it's still necessary to check against basically a data input error. Also note that if you go back to the prior tab and you go down to that reconciliation item, it will give you a difference. See, it says bank transaction source over here. So if you'll see the ones that were kind of manually reconciled down here, because it'll say user down here rather than imported. Now, once you're done with the bank reconciliation, you may want to go down and say, okay, we've reconciled for March. Let's go ahead and publish it. And that kind of gives us our permanent, basically, record saying, hey, it was reconciled. It's been reconciled at this point in time. So it should kind of save that reconciliation. And then if something happens that kind of changes the data in the future, then you already have your basically saved reconciliation here. And you should be able to basically hopefully use that to see if there's any problem. In other words, if someone in the future backdated something or changed something in the past that had already been reconciled, you want to basically show, hey, I was reconciled at this point in time as of this date, and then hopefully you can use that to go back and figure out any problems that may happen in the future. So that's it for now. Let's get out of here.